Hey everyone, and welcome. Today, we're jumping into a huge question. How in the world do you measure the entire economic output of a country? I mean, everything, from the coffee you bought this morning to the giant skyscraper being built downtown. All right, let's get into it. We're going to break down something called the value-added method, which is the really clever way economists get a true picture of a nation's income.
And that, right there, is the #1 challenge. Think about it. If a farmer sells cotton to a textile mill, and that mill sells fabric to a shirt factory, and that factory sells a shirt to you, how do we add all that up without counting the value of that original cotton 3 separate times? It's a real puzzle, and if we get it wrong, we end up with a completely distorted view of the economy.
And this is exactly what that distorted reality looks like. We call it the inflated view. It's what you get if you just mindlessly add up the sales of every single business. Sure, the number looks massive, but it's blurry, it's confusing, and honestly, it's just plain wrong. It's like looking at the economy through a funhouse mirror.
Now, this fundamental mistake actually has a name, the double counting problem. But don't you worry, there is a way to wipe the lens clean and get a crystal clear picture of what's really happening.
This slide just lays out the trap perfectly. Look over on the left. The wrong way. If we just add up everyone's output, the farmer's 100 rupees, the mill's 300, the manufacturer's 550, we get a bloated total of 950 rupees. Why? Because we counted that cotton's value 3 times. But now look at the right way. We only add the new value that was created at each step, and that gives us the actual correct market value, 550 rupees.
And that is the secret sauce. It's called the value-added method. It works by only summing up the increase in value, the new wealth that's created at each and every stage of production. It's a brilliant way to isolate what each business uniquely contributed, and it totally avoids counting the same inputs again and again.
To really let this sink in, let's make it super simple. We're going to follow the journey of just one product, from a little puff of cotton all the way to a brand new shirt you'd find in a store.
So, our little story here has 3 main players. First up, we've got the farmer, who grows and harvests the raw cotton. Next, the textile mill buys that cotton and turns it into fabric. And finally, you have the manufacturer, who takes that fabric and stitches it all together into a finished shirt, ready for us, the consumers. Okay, let's look at the actual numbers on this table. The farmer makes 100 rupees worth of cotton. Now, since they basically started with just seeds and soil, their cost of inputs, what economists call intermediate consumption, is 0. So their value added is the full 100 rupees. Simple enough. Now the textile mill buys that 100 rupee cotton and turns it into 300 rupees of fabric. So their value added is their output, 300, minus their input, 100, which is 200 rupees. Finally, the shirt manufacturer buys that 300 rupee fabric and makes a 550 rupee shirt. Their value added, 550 minus 300, which is 250.
And here is where the magic happens. What do you get when you add up all those individual value-added numbers? You get 100 from the farmer, plus 200 from the mill, plus 250 from the manufacturer, and it equals exactly 550 rupees. See? This shows the core idea perfectly. The sum of the value added at every single stage is exactly the same as the final price of the product. No inflation, no double counting, just a clean number. Okay, so that's one shirt. Now, just for a second, imagine applying that exact same logic to every single thing, every good, every service produced in an entire country for a whole year. That is how we scaled this idea up.
To do this for real, economists use a pretty methodical 5-step process. First, they identify and classify every single producing business. Second, they figure out the total value of everything they produced. Third, they calculate the value of all the stuff they used up in the process. Fourth, they find the gross value added for each sector. And fifth, they make a few final tweaks to get to the true national income.
So let's zoom in on those first 3 steps. Step 1 is all about sorting. Every business gets put into one of 3 buckets. You have the primary sector, think farming, mining, anything from the earth. Then the secondary sector, which is all about manufacturing. And finally, the tertiary sector, which is all the services, banking, IT, transport, you name it. For every one of those businesses, we then calculate their value of output, which includes their sales, changes in their inventory, even stuff they make for themselves. And from that big number, we subtract their intermediate consumption, basically the cost of all the raw materials they used up to make their product.
Then comes step 4. We take that gross value added, or GVA, that we just calculated for every single business, and we add it all together. the GVA from the primary sector, plus the GVA from the secondary sector, plus the GVA from the tertiary sector, all of it flows together to give us a number you have definitely heard of, Gross Domestic Product at Market Price, or GDP-MP. This is the total value of everything produced inside a country's borders.
But we're not quite at the finish line. To get from GDP to the purest measure of national income, we have to make 3 key adjustments. First, we subtract depreciation. That's for the wear and tear on all the machines and buildings. Then, we subtract net indirect taxes, which is basically taxes minus government subsidies. And finally, we add in net factor income from abroad to account for money flowing in and out of the country. This final number is called NNP at factor cost, and that's our true national income.
And here it is, the whole shebang in one consolidated formula. We start with the sum of all the value added. Remember, that's just output minus inputs to get our GDP. From there, we make our adjustments. We subtract depreciation to go from gross to net. We subtract net indirect taxes to go from market price to factor cost. And we add net factor income from abroad to go from domestic to national. And boom, that gives us our final true measure of national income.
Now that we've got the big formula down, we need to look at the fine print. I mean, to make sure this number is as accurate as it can possibly be, economists have to follow some very specific rules of the road about what counts and what gets left out.
The basic idea behind these rules is actually pretty simple. We want to include anything that represents new productive activity happening this year, and we exclude anything that's just moving old stuff around or was already counted before. Getting these details right is what makes the final number so powerful.
So, for instance, we include things a farmer grows and eats themselves. Why? Well, because it's still new production that happened this year, so it gets an estimated value. We also include the commission a broker makes selling a used car. The car itself isn't new, but their service of selling it is a new activity. On the flip side, we of course exclude the value of the used car itself, because that was counted way back when it was first built. And naturally, we exclude all intermediate goods to stop that pesky double counting problem.
The rules keep going for things like property and money. We include something kind of weird called imputed rent for people who own their houses. The logic is that homeowners are basically providing a housing service to themselves, and that service has value. But we exclude financial stuff like buying stocks. That's not creating new value, you're just transferring ownership of something that already exists. Same goes for government payments like Social Security. That's just money moving from the government to a person, not a payment for new production.
Okay, so I know that was a lot of calculating and a lot of rules. But you have to be asking, why do we go through all this trouble? Why does this one number matter so much in the real world?
Well, it really boils down to 3 huge reasons. 1, it ensures accuracy. It systematically gets rid of that double counting problem we started with. 2, it actually shows us where the economy's strength is. Is the country driven by its farms, its factories, or its service sector? And 3, and this is the big one, it forms the basis of policy. It gives governments the hard data they need to make smart decisions and plan for the future.
And just like that, we've come full circle. We started with this blurry, inflated view on the left. But by carefully, step by step, applying the value-added method, by isolating the real contribution of each producer, we've replaced it with the real picture on the right, a clear, accurate, and powerful understanding of a nation's economy. So, we have an accurate number for national income, but that really just leads to a much deeper question. Having a precise number is one thing, but what does that number truly tell us about the quality of life, the happiness, or the overall well-being of the people who live in that nation? That's a thought to really chew on. Thanks for joining me today.